Robert, I hear yesterday that you had a blackout at the stock market. Did that have any impact on trade?
Good morning. Yes, there was a blackout experienced yesterday. It did affect trading because we use online systems and we use power. But it was back up, and I guess we managed to get back on our feet and things resumed as normal.
Let's focus in on some of the big movers of the day. Of course, Equity Bank always comes to the fore as one of the top stock movers, accounting yesterday for 92 million worth of shares traded. The stock goes ex-dividend today. What are your thoughts on the stock's trade in light of the fact that we've got news reports out now that the tax bill for the company is set to rise by as much as around 10%?
Well, Equity Bank has a good record. The results were really good for the full year 2011. We have news in that the tax rebate they've had since listing in the stock market will finally come to a close after 5 years. So this may indeed affect their books. But looking at the stock moving forward as they close their dividend payout today, I think it's still a stock worth investing in. There's still a lot of room for growth. If we look at such banks, they did a lot in increasing their loan provision portfolio. They have grown their assets. They have also grown the income they receive from interest. So I guess there's still a lot that can be gained from the banks, and Equity is no exception.
Let's focus in on the tourism sector. TPS Serena falling back yesterday, of course, reporting a 23% jump in full-year pre-tax profit. That as a result of the recovery in the tourism sector last year. But going forward into 2012, a lot of concerns being highlighted by the tourism minister over the Eurozone debt crisis and the Eurozone, of course, sovereign debt crisis, the impact that's going to have on growth there, and then tourism arrivals. And then, of course, the fact that you've got governments across the globe warning citizens about traveling to East Africa right now. What are your thoughts on getting exposure to TPS in light of the fact that there are a lot of concerns around the outlook for tourism this year?
Those concerns are very real, and I think the company has something to deal with here. Number one of the mitigating factors is political risk. We are in an election year. Probably it will be earlier next year, but there's still a lot of political uncertainty, especially because people do not want to see a repeat of the chaos that came from the polls in 2007. Other than that, as you mentioned, we have the Euro crisis, which has actually squeezed credit, and we have fewer tourists coming into East Africa. And also we have another mitigating factor being the terror threats we've had in our country. Last week we had an attack on us in a local bus station. So all these are mitigating factors. But looking on, I guess, where these companies such as TPS can capitalize on is local tourism, especially now we're moving to Easter. They may try to milk out what we have regionally and locally.
And also, the likes of Dye & Blair citing that it's a resilient business and it has a resilient business model. They say it's a growth stock. So what are your thoughts on exposure to it in light of the fact that there are, of course, a lot of risks right now, but going forward, this might just be a blip 2012, but from a longer term perspective, there might be some upside in the stock.
Definitely, and also we must remember they still have a lot of promise from the investments they've made. They opened a lodge in Elementaita, some part in Rift Valley province in Kenya. They've also moved into East Africa. They're in Uganda. They've also been conducting throughout 2010. I think to date they've been doing a lot of renovation on some of their top-notch hotels. And some of these spending, some of these investments will actually be felt more in the long term than it is in the short term. So I guess if they could brave the storm 2012, maybe by next year we would see some of these good returns come to fruition.
Are you, let's focus in on the telecom sector. Are you buying into the fact that Access Kenya, of course, has made a strong recovery in 2011 and perhaps might not be a target in terms of acquisitions right now? Do you think the company is still vulnerable even though it's managed to turn around its earnings?
Vulnerability for Access Kenya lies in the market and the industry they find themselves in. They find themselves with a lot of stiff competition. All the same, they've done a good job from coming from lost territory last year, coming into profit zone, and earlier this week, they reported a 2% increase in profit. So I guess they're doing things right, and they are moving into high-end ISP provision in homes, which actually has been untapped by the bigger players, some of their competitors. So I guess if they work on a sound business model and continue doing what they have been doing, we expect the recovery to continue, and perhaps by the time they're reporting the 2012 results, we'll see something much better.
Let's just look at the broader macro issues right now and how they're expected to feed into company earnings. Just looking at the likes of Access Kenya, they managed to contain costs, bring them down by 35%. That was at a time where we saw inflation soaring last year. Of course, this year, the focus perhaps is on the fuel price and the impact that's going to have on earnings. What are your thoughts in terms of how that might feed into companies' earnings? Because overall, analysts are saying that companies have actually been quite resilient in the face of soaring inflation from last year.
That is true. I guess they've had a stable cushioning for the forces that have played against them. Inflation is still a very real threat, especially because we have fuel prices, international fuel prices at a high, and they're expected to be higher. Here locally, we had the Energy Regulatory Committee again revise the prices upwards, and we know the effect of fuel is pervasive in the economy, no matter which sector you find yourself in. And I guess when looking at it from maybe a macroeconomic perspective, we can say there's still a lot of pressure for the consumers of these services, consumers of the products, consumers of the services provided by these companies, because they have less money and they have more pressure to focus on other needs rather than adopting these services.